Hi, good afternoon to all of you. I'm Stefan Schneider. I'm the owner of the German M&A Review magazine on behalf of M&A Review Europe. The session today is focused on the topic M&A insurance on carve-out transactions. We welcome our speakers from Howden M&A and Liberty Transaction Solutions. Both speakers have already been here on the stage. For those who have not attended yet, a short introduction. Gennady, who is on the left side here, visible on the screen, is an executive director at Howden M&A. Prior to joining Howden, Gennady was a vice president in Citigroup's investment banking practice in Frankfurt and Moscow. At Howden M&A, Gennady has led the placement of some of the most complex and sizable transactions in the German market. And on the right picture, and the right photo, you can see Markus Messinger, Dr. Markus Messinger. He heads the Liberty's Global Transaction Solutions Frankfurt office and leads the Liberty team for Northern Europe. Before joining the team in 2017, Markus spent more than 6 years as a qualified lawyer in the corporate department of an international law firm. This should be enough for introduction. Please, Gennady, Markus, the stage is yours.
Many thanks, Stefan, and many thanks for everyone who has found the time to attend the session on a Friday afternoon. Probably not the ideal time slot, but we hope we'll be able to sort of have a vivid discussion on something which I think can be certainly called a hot topic, sort of in the current M&A environment. And I think the purpose of this discussion would be to really sort of have a rather open dialogue with you, where we will first, of course, run through a couple of sort of specific issues related to implementation of W&I insurances in a carve-out complex. I think everyone will know a carve-out is a complex transaction in itself, and then the challenges which come along introducing an additional work stream, being the warranty and indemnity insurance, is of course something all sort of process participants need to carefully manage. And I think we would very much welcome any questions, suggestions, whatever might come up sort of during the conversation and as we proceed. So please feel free to sort of to raise your hand and raise any questions, and we will try to address them as detailed and as efficient as possible. Now, as I said, and obviously appreciating that we have a rather diverse group of attendees here, also when it comes to sort of the general familiarity with the W&I insurance topic, I'm sure you have been able to sort of educate yourselves on some of the previous panels, on the articles published, and obviously having dealt with the topic in your day-to-day life. So I don't think we will be able to cover sort of different elements of a basic W&I insurance. We can of course touch upon certain things which you might have encountered in the past, but I think generally the idea would be to focus on some aspects which are indeed specific to a carve-out setting. Now, I think thinking about carve-outs, we all think about sort of some sort of a standard setup. You have a rather large conglomerate, and then a certain part of the business needs to be spun off, needs to be separated, and a whole lot of specific challenges will arise in that context. And I think when we think about different carve-out settings and sort of looking back at some of the deals we have advised on in the recent past, I think one important consideration for basically all work streams attached to that is obviously something I would refer to as a standalone readiness of the asset. So we currently have two situations where the sort of the starting point is a very different one, whereas in one specific setup, the target is largely autonomous. So it has been part of a larger group, obviously, but it has been run in a rather independent way. with a specific management largely independent of the parent. This is sort of probably a scenario which makes the carve-out a bit easier from various angles. And then obviously the more challenging setup is when the company was indeed very closely interconnected and embraced into the operations of the target. That brings a whole lot of challenges from an operational perspective, and that will then equally translate into a more complex contract drafting on the SPA side, on the asset transfer agreement side, and sort of on the overall transaction documentation, and will inevitably lead to a higher complexity when it comes to discussing the warranty and indemnity insurance, because that obviously, as always, is very much building on what is available in terms of deal documentation, and obviously the specific risks attached to that will also be scrutinized more heavily if it is clear from day one that the carve-out is facing a whole lot of interim steps in order to make the separation work from an operational perspective. Now, again, where does the W&I insurance product fit into this already complex setting? I think it is fair to say that we see an increased interest from a corporate seller perspective or from a corporate separator perspective to actually introduce W&I solutions into this setup, because ultimately, yes, it is an additional complexity, but ultimately the intention of the seller is to have a clean exit, and equally sort of involve a W&I insurance, because sort of without we will touch upon various challenges, but I think the core message is that carve-out transactions have become absolutely insurable over time. So it has been a learning process in the market, but I think it is fair to say that by now we have done a plenty of those deals, and you need to know the issues and you need to navigate around them. But it is well insurable if sort of all parties know what they're doing and sort of adhere to certain principles, both on the sell side in terms of disclosure, in terms of making clear that the carve-out plans are closely followed, as well as on the buy side, where of course it comes to sort of providing comfort to insurers by having conducted a comprehensive, detailed, yet focused due diligence process. And I think sort of if you think about that from a typical M&A process perspective, the typical questions we have seen is sort of, okay, when do you actually have to start thinking about a W&I insurance in the context of a carve-out? And I think something we've been telling clients sort of all over again is that, again, given the additional complexity, given a whole lot of sort of flying parts which need to be pulled together in a rather ambitious timeline, typically, how do you manage that all? And obviously the core message is sort of course, involving a W&I insurance broker rather early on proved to be very sort of helpful, just to make sure that a certain peculiarities of what W&I insurers would ultimately expect from a carve-out transaction, that this has been factored in. It can relate to certain operational topics. It can relate to contracts drafting, and sort of to the overall setup. How do we set up the financials? How do we what do we do on the tech side? So all of these things can be adequately discussed on the sell side. And then there is obviously if you think about that in terms of how would the W&I process work in a carve-out scenario, of course, there are sort of the usual sort of options and alternatives when you can run a rather sort of comprehensive discussion with insurers on the sell side, i.e. educate them in a more detailed way and manner on the target, on the envisaged transaction, and potentially even deep dive into a detailed analysis of various sell-side reports. Something we refer to as sell-side underwriting, i.e. the insurer will will take a deeper dive into the asset, into the reports, and sort of provide a little bit more specific guidance to us and sort of raise some red flags as appropriate when it comes to expectations vis-a-vis the buy-side diligence exercise. And equally, it is a similarly widely used option when sort of on the sell side, we rather sort of have a higher level discussion. The insurers will not sort of take a deep dive into the vendor materials, but rather sort of familiarize themselves with the asset, with the transaction documentation, and provide indicative terms on that basis. And then the process flips, as we call it, to the buy side, and it is then with the buy side to bring that over the finish line. And Marcus, probably quick question to you: How do you guys experience that? What were the lessons learned when you compare those two options? Now, sort of taking different pros and cons when it comes to sort of really diving into the detailed underwriting on the sell side, as opposed to sort of to the more let me say historically customary process of rather taking a deeper dive once you have been introduced to the buy side. Marcus?
Thank you. Yeah, thank you, Gennady. I mean, one point to where I definitely support your statement. I mean, it's definitely helpful to involve a broker on the sell side already. That will give you a certain indication on crucial points in the transaction process, in the underwriting process. I think for sorry, Gennady, can you go on mute because I hear myself twice. Yeah, thanks. That's much better. So differentiating the two different kinds of underwriting. I mean, it's kind of what we call a soft staple, where we have given initial view on the transaction documents, initial view on pricing, and initial view on coverage. I think that is probably already helpful for the process and for the sell side. Of course, I mean, for me being in the shoes of the insurer, a sell side underwriting with a detailed look at the due diligence has a lot of benefits for us for the further underwriting process. I mean, we then have actually direct access to the sell side. We can ask questions directly to the sell side and discuss the crucial points already at that stage with the sell side and have a dialogue there. I mean, maybe an interesting observation is that when looking at the different jurisdictions across Europe, we see it. This process used quite often in the Nordic market to have a full sell side underwriting where the materials on the sell side are available. So that means, I mean, of course, it always requires to have extensive vendor DD materials. Otherwise, we don't have anything to base our underwriting on, and then the whole exercise doesn't really make sense in the first place. But we've had positive experience with both approaches. I think for the sellers, it definitely is more work on the sell side if you do have the a full underwriting work stream. But I think it has its benefits, and then help to bridge a few or avoid a few pitfalls that otherwise might arise. I mean, we can give input on the warranty catalog. We can give input on the diligence that we would expect on the buy side through some kind of guidance note. Those are aspects which we can do on the sell side.
Yeah, no, absolutely, and I think you've touched upon probably the most critical point when we see sort of discussions on the sell side, because yes, there is indeed potentially an additional sort of layer of involvement of various sell side advisors, because it only really makes sense if there is an additional sort of round of Q&A being conducted on the sell side. So it is something which needs to be planned for. And I think from our experience, probably to a certain extent, a function of the general deal dynamics and the general timeline. So if the sort of the buy-side diligence stage is rather short and ambitious, as it quite often is the case, then of course it does make sense to try and front load a whole lot of this work to the sell side, and indeed being quite open from a cost perspective. At least that was our experience on deals where this was done. From a cost perspective, the cost associated with this additional step on the sell side is rather negligible. So this is not really a factor. Nevertheless, sort of it is rather something where we need to make sure that the relevant advisors in particular, and primarily this refers to legal tax, might also refer to the financial advisor, we'll come to that in a minute, that they are available for addressing your questions. And that is something which then makes sense in that context. And I would also say that probably it is, to a certain extent, of course, it is a question whether detailed materials are available in the first place. Something you I think mentioned is probably more standard in the Nordics, or at least sort of in the non-DACH regions, because I think at least based on what we have seen, typically sort of on a typical DACH sell side, and then this will equally relate to Carve-out as well. You would rather have fact books, not Facebooks, but fact books, as opposed to full sort of vendor reliance-based reports. But nevertheless, I think what you've said will equally apply to a fact book. So it doesn't have to be a full vendor DD report in a narrow sense. Would you confirm that, or
Yeah,
have
definitely.
you had different experiences?
No, definitely. I mean, if it is more comprehensive and there is more legal assessment in it, even better. But if it already a fact book style or a fact book style definitely helps or is capable of being the basis for a sell side underwriting. It is then more a question for us on the when we prepare our guidance note for the buy side, what we think are the focus areas of the DD. Then if it's clearly a very factual information basis that has been provided on the sell side, then we'll look for more analysis, legal conclusions, and or tax conclusions, tax risk shown on the buy side, which is of course less the case if we have a full vendor DD report, where then a kind of a mere top-up DD from the buy side makes more sense.
Yeah, no, I agree. And I think probably if it is indeed a fact book on the sell side, then obviously the expectations relating to the buy side DD are obviously a bit more specific. It has to be a little bit more comprehensive, but equally, if you turn that around, probably it is easier to indeed influence that and make sure that the buy side really sort of provides an analysis you would expect, as opposed to a full sort of vendor DD situation where sometimes the buy side have much less time and also a little bit less sort of room for maneuver, because it is then typically rather closely followed by what the sell side has conducted. So maybe it is even a setting where the buy side can still create something that will ultimately be more suitable for insurance discussion.
Yeah, definitely agreed.
Yeah, and I think another point we've typically discussed quite heavily, either sort of on the sell side or in fact on the buy side, when it comes to somewhat more complex, let's say large scale carve-outs, the whole discussion around sort of the jurisdictional split and how to find sort of the right balance between sort of, okay, here is the asset and it comprises of, in some instances, 20 plus individual entities spread across the globe. And how can you reasonably diligence that in a typical M&A DD framework, which will be facing numerous challenges, both cost-wise, but equally time-wise. So I think indeed, as you said, obtaining that specific buy-side guidance note proved to be extremely helpful to manage expectations early on. And it is indeed, if you think about that from a process perspective, this is something which should be communicated to bidders at a stage when they are just about to start their diligence exercise, i.e. at the stage where the scoping discussion is really happening, as opposed to having that discussion a week before the process finalization, before the final bid, or sort of closely or shortly ahead of DD finalization. There is simply typically too late, because if we want to make sure that the scope works, this discussion has to happen rather early on. Typically, sort of when bidders are being granted VDR access, typically beginning of phase 2. This is sort of the natural point in time where, if you think about that from a sell side perspective, if you are sort of running the carve-out transaction on the sell side, this is sort of the natural point in time from which you can then back engineer, so to speak, reverse engineer the timeline for initiating the W&I process. And then I think typically, if it is indeed intended to run that on the sell side, you probably need again, depending on the complexity of the asset, depending on the sort of state of standalone readiness, you have to plan for sort of 3 to 4 weeks, probably in an ideal scenario, to really make sure that the insurer has sufficient access to information, and that there is also sufficient time left to address those questions on the sell side, which will then be digested and ultimately presented to the bidders by way of a sort of specific DD guidance note, which I think, again, is of particular relevance on more international and on more complex carve-out transactions.
Yeah, agreed. I mean, maybe a couple of words from an insurer side when we're looking at, those international transnational carve-out transaction with a big geographical spread. I mean, first of all, of course, we always assume and hope that the diligence is primarily carried out for the bidder to get themselves comfortable with the transaction and with the target, and not for the insurance. Of course, the full reality is that the W&I insurance works in a way that, as a basic principle, we cover the unknown risks based on a comprehensive diligence. So an area has been diligence, but of course there can always be unknowns that have not been catched in the diligence, and those are the risks that we are covering. So every time we have certain countries, certain subsidiaries not diligenced at all, this is something. Yeah, it's kind of a black spot for us, where we then have to see whether we can deviate from this basic principle and still provide coverage. And I mean, just from an insurer side, what do we look at then to assess whether we can grant such kind of black spot coverage? First of all, for us, it's very interesting to see what kind of functions are centralized within the group, and which are basically run from the operations in the several subsidiaries. So for example, if the IP is centralized, whether they maybe some kind of HR functions are centralized. Sometimes the procurement functions are centralized, and if those, and we would of course assume that those are then have been diligent, and that kind of gives us the opportunity to make assessment in relation to the subsidiaries or the jurisdictions that have not been part of the diligence. And then of course we will look at the different we look at kind of financials, revenue, EBITDA that is generated in those jurisdictions that have not been part of the diligence. How much FTEs are there? Are there manufacturing side there, or is it just mere sales functions? Those are all aspects that kind of factor in into our assessment. And as said by Gennady, if that can be done at an early stage on the sell side, we can highlight where we will have troubles providing we will have troubles providing kind of blind spot coverage, and that can then be caught in the buy side DD.
Yeah, absolutely. Maybe a quick question to the audience, whether there are any questions so far. I think we are now sort of about half time. I think there is a function. If you want to raise a question, you can raise your hand, and then there will be an alert. We shall see. So do shout if there is anything. I think moving on. And I think we briefly touched upon that. Yeah, sort of in terms of analysis of various sort of countries, in terms of giving guidance on the due diligence to be conducted. I think another sort of carve-out specific topic is typically the financial statements warranty ultimately, but and the question which investors will typically raise. What is the sort of the framework, the financial framework on which the valuation is ultimately to be based? And the challenge in a carve-out scenario is typically that, at least in many instances, the parameter which is now being carved out is actually created just for the purpose of the envisaged carve-out. So it hasn't been operated as a sort of combined entity in the past. And from a financial perspective, there is obviously a challenge to create, and typically for the first time, to pull together a set of financials which will indeed capture the relevant perimeter. Now that is an overriding issue, and I think we then have a consequence of that in the W&I setting, where the financial statements warranty, which ultimately sort of reflects that discussion, will be hotly discussed vis-a-vis insurers, because as you all know, from a financial bidder perspective, or generally from a financial perspective when assessing a transaction, having a robust set of numbers is obviously key to have that discussion. So I think, again, in practice, we have seen various sort of alternatives, how this has been implemented. In one instance, we had the luxury that the perimeter was indeed created specifically for the separation, but it was intended to be spun off and to be listed ultimately. So there was a requirement to prepare a full set of audited financials for the last 3 years, because this is required for the capital markets. And we then obviously benefited from that because it was then turned into a dual track process. And ultimately the M&A track prevailed. So in that instance, we had a full set of historic financials, which were subject to an audit. Now that, of course, translates into this provides the highest possible comfort to insurers, and then obviously translates into a higher standard of coverage under the policy, which then creates a little bit sort of additional comfort to all parties involved. Now that, as I said, is more of a luxury situation. I think the more classic scenario is that the financials are being prepared as a set of, let's say, advanced sort of management accounts with the usual topics of creating pro forma consolidated accounts for the first time. And in some instances, sort of facing the challenges of pulling together numbers from historically different entities using different accounting systems, etc. So it might be quite a challenging exercise in preparing those. And then there is obviously a whole degree of sort of subjectiveness attached to that when it comes to really sort of presenting a final set of numbers, typically including a whole lot of so-called standalone adjustments. Sort of a transition from as is world within the sort of the corporate group, moving on to a real sort of standalone existence, creating a whole lot of sort of additional functions and additional costs which need to be factored in to present the business on a sustainable standalone basis. And I think the core message here from our perspective is that even if you are facing that situation where the financials will be drawn up, and it is indeed sort of something which the management is in charge of, it will not be sort of reviewed or audited by an external auditor, Wirtschaftsprüfer. It will be simply a sort of, an advanced set of management accounts, which has been discussed with the financial DD provider on the sell side, but there is no formal assurance attached to that set of numbers. This will not mean that the numbers are per se not insurable. It will, however, typically be reflected in a lower standard of coverage. So this is again something which we need to understand very specifically, how that is being prepared on the sell side, what the sort of the underlying assumptions are, and in particular what the process is behind pulling together that set of numbers. And then, of course, there is always a discussion: will there be sufficient time to maybe conduct a review of those numbers? The typical answer, unfortunately, is not, that this will not be possible. But as I said, even in that scenario, there are certain alternatives from a wording perspective which can be reflected. And again, this is something which needs to be part of the alignment exercise, irrespective of whether we go for that option where the insurer is being closely involved from day one on the sell side, or at least something where an alignment should be taking place between the broker, the lawyers, and the sort of the financial team, just to make sure that whatever is being reflected in the discussions is ultimately insurable, and that this alignment will not create sort of, or this will at least minimize the risk of any sort of surprises further down the line. And that is then something we also very early on flagged to the bidders, that this is sort of the setting. This is something you can do. This is something you have to diligence, but sort of you will not be able to get the highest standard attached to those financials. Marcus,
Yeah,
anything to add from your perspective?
definitely agreed, and not too much to add. Maybe just describing how we approach that and how it works for us. Assuming now for a second we don't have the scenario where we have been engaged with the sell side for a while and have discussed with them all what has been done on the vendor DD. Assuming the scenario we coming in on the buy side, I think that the first step from our side will be after reviewing what the target is all about, how they're operating, we'll have a look at the financial statement warranties and trying to understand how they are drafted and which accounts they are referring to. And as Gennady, as you said, there is a wide variety from kind of consolidated or combined accounts to financial statement warranties on standalone accounts by certain subsidiaries or entities within the target group who have already been operating on a standalone basis. Then there is the question: has there been audits? Has there been an audit on such standalone accounts, or are they unaudited, or do we even speak about management accounts? And moving back to the consolidated ones, kind of the same question: audited, or maybe some kind of auditor's review on it, or nothing at all. Then kind of the next question moving on from there is our question: so what kind of diligence has, or how did the sell side arrive to that numbers, and what kind of diligence has been done on both sides to either to verify those numbers? And ultimately, as you said, we will try to match the wording in the warranties to the review standard. So a true and fair view equals a full audit. If there is some kind of auditor's review standard, which is given by the guidelines of how such reviews are supposed to be conducted, then we will try to match that language. If there has been no auditor's review, then it will be definitely a lesser standard than true and fair view, and then we will need to discuss how the exact wording should look like, but it will be clear that it will be less than the true and fair view. But I think that the third bucket when we kind of when you can say those are three kind of levels of review types. That is the most difficult one for the insurance. All against the background that an audit always provides comfort, and also that the most severe claims that we see on the W&I is on the financial statements. So I think the last factor will always be the most tricky one. But as you say, they're not per se uninsurable. It will just require more input in the underwriting and more discussions around it.
Yeah, absolutely. Now, I think speaking about sort of limitations of what can and cannot be insured, it's probably a good transition to another element which I think we should touch upon. And I think this is something, if I want to put it in a rather provocative way, something which typically is being again heavily discussed is is the exclusion on sort of carve-out implementation risks, which of course sounds like a rather comprehensive one, given this is sort of the backbone of a carve-out transaction. So why don't we spend a little bit of time on that, just to sort of see the different nuances there, and sort of try to differentiate in terms of what insurance can provide on that end and what it cannot provide. Maybe as a brief intro, just sort of to make sure that everyone is on the same page. You have typically thinking about your sort of usual regular carve-out. Of course, it is never a regular one, but just sort of thinking about this from a structural perspective. A question which is frequently to be answered is, when is the real physical and sort of legal transfer of assets, of employees, of facilities? When does it all happen? In some instances, it can happen pre-signing. So the group company decides that we will carve this out. We will make sure the separation has been completed. And then we will start sort of the M&A process, or whatever, the IPO process in parallel, or shortly after the separation has been implemented. So after all sort of the internal steps have been completed. Now that is probably a somewhat easier case from a W&I insurance perspective, because again, these steps have been completed. They are therefore more accessible to a customer diligence exercise. Now, if you have probably a more frequent scenario where the carve-out is actually, it is being prepared, it is sort of being conceptualized prior to signing, but the actual implementation will only start place once the group company actually sees, okay, I have a deal on the table. It does make sense for me to sort of really start that, to a certain extent, painful process of sort of carving things out, running a whole lot of internal steps and resources to implement that. And that, of course, then equally means, okay, there has to be something which ultimately ensures that that the whole perimeter is actually being available. And naturally, if there is no liability on that from a sell-side perspective, the question also will arise in the context of a carve-out deal. And that is, Marcus, probably the topic of where in some instances at least we are discussing that in such a framework, i.e. carve-out being deemed, at least from a looking at that from a signing date. So the deal has been signed, but the carve-out has not yet been implemented. This seems like a forward-looking event which will take place between signing and closing. Can you maybe spend a minute on how you guys typically deal with that, and what the options are?
And I mean that's indeed a very tricky one. I mean the as you said, the scenario where the carve-out has been completed, everything is ready and available at signing and can be diligent at that stage, and we can we can assess it. But the scenario where the carve-out is to be implemented between signing and closing, this is difficult from the perspective of the W&I insurer. Why is that? I mean, going back to the basics concept that I mentioned before, so coverage of unknown risk despite comprehensive diligence, that's how the W&I is set up and how retention levels and premiums are calculated. In a carve-out scenario that is implemented between sign and closing, there is simply no DD possible on the implementation measures because they have not taken place yet. But on the other hand, the policy is already, the deal is signed and the policy usually accepts at signing. So the policy is put in place prior to that measures to be taken place, which will normally lead to a scenario where the restructuring measures to be undertaken between signing and closing are excluded from, or losses resulting therefrom are excluded under the W&I policy, and then it's a bit on the burden on the buy side to have that kind of agreed with the seller that to be protected against that something goes wrong in this process. And then typically what we see in SPAs are of course certain types of wrong pocket provisions, meaning if an asset that is actually belonging to the carved out business is not transferred, it will be transferred after closing if that can be proven that it belongs to that business. So that is kind of the typical protection that the buyer has in that space. Having said that, I mean that of course sometimes is misunderstood to say everything around, let's say IP rights, sufficiency of assets, certain liabilities in connection with employees, etc., are excluded. This is not the case. I mean, there are a variety of things that still can go wrong, which are captured by the warranties. For example, if IP rights or other assets are not within the seller's group, but there is some kind of third-party challenge, that has nothing to do with the carve-out per se. So that is something that it would still be captured, and that is a similar scenario as a W&I transaction, W&I insurance without not a carve-out transaction. I think that's and that's kind of the differentiating factor, and it also has to do with how much measures have to be taken place between signing and closing. Again, even if a carve-out is taking place between signing and closing, certain entities of the carved out group might already operate on a standalone business. So for those, you don't have the hard carve-out measures where you transfer assets from A to B, where you transfer employees, where you transfer IP rights, etc. And this is then, of course, a bit of a different setting. But I think there's a question.
There is indeed a question, Frau Heuler.
Yeah, thank you very much. So far, one question on the context of implementing a carve-out in the period between signing and closing of a transaction and insurability in this regard. How about doing a top-up due diligence in that time period, diligencing certain implemented items? Would that then be possible to be subjected to the insurance as sort of subsequent addition?
Yeah, a very fair question. I think from our perspective, at least, we have that we have seen that in a couple of deals where that option was implemented in the insurance policy. And I think it is fair to say that it is feasible. Some of the challenges we found out was that, you can diligence certain things quite well from a legal perspective. For instance, you can sort of check the registers, have the IP rights been indeed transferred? Are they now registered with the target as opposed to the parent? That is something which can be done. But equally, we found out that a whole lot of those implementation topics is of a very sort of factual nature. It is like, to mention a stupid example, if the chairs and tables and like the facilities, if it's all been like physically now separated, that is something which proved to be rather difficult because that isn't something you can actually diligence by way of a typical sort of desktop review. It is something which needs to be sort of diligenced or discussed very closely with the management. And that proved to be somewhat more challenging than sort of checking, let's say, the typical legal boxes in terms of IP rights, in terms of employees transfers, etc., sort of lease agreements, all of this. So I think to the extent this refers to sort of those topics which can be adequately diligenced, I think this is a valid approach. But again, I think if you then find out something in the course of that diligence exercise, you still have an issue, because if there is indeed nothing under the SPA to provide protection, the insurance will always tell you, look, it has been now identified that there is a certain shortcoming attached to the implementation. That is not something we will cover. Yeah, so I think at least for the interim stage, you should probably be referring or relying on the sell-side protection around wrong pocket clauses. If then the DD exercise around closing proves that, okay, we actually were able to tick a lot of boxes and to provide comfort to the insurer, I think it can be a viable way forward. But maybe I'm too optimistic, Marcus. What's your sense?
Well, no, I would, you know, all agree with all of what you said. I mean, it's definitely. I mean, we have to look at basically topic by topic. As you said, you know, if you're speaking about share transfer, you know, one of the carve-out measures can be share transfers. I mean, that's definitely something that the buy-side advisors can look at once that has been taken place, and have do some kind of diligence around it. Same with IP transfer. More difficult with you know, taking all, let's say, all assets together. You know, have all assets been transferred? That will be quite challenging to diligence, and I've rarely seen that, or never seen that really. But maybe one point to add, which goes into that direction where we already see that more often, is the question of on the tax implications of the carve-out measures. This is then something that goes into the direction of specific tax insurance, where you say there is a, you know, we have this is our steps paper, our restructuring, restructuring step plan. This is how we think the tax consequences will come out. But of course, always in every tax restructuring, there might be some low or remote tax risks, and potentially that is something that is insurable. You know, that is to be looked at separately from the W&I, but still within the global heading M&A insurance.
Yeah, agreed. Frau Heuler, does it answer your question?
Yes, thanks.
Okay, great. Yeah, Marcus, and I think you've touched upon another hot topic inadvertently, but we'll probably have to jump into at least mention that indeed the tax implementation, the tax structuring is another area of sort of increased scrutiny by insurers, and that is also something where again the W&I insurance in its basic form will probably have certain limitations. I think there was another sort of a separate panel on addressing tax risks in an M&A context, and I think the similar logic is ultimately applicable to any sort of taxes or tax risks associated with a carve-out transaction. I think thinking about sort of some of the deals we have seen, probably some of the classic tax-related discussions were around sort of the tax neutrality, or whatever the right English word might be, but sort of whether the assets have been transferred in a tax-neutral way. That is something where I think the tax advisors can have quite diverse views when you compare sort of the sell side perspective and the buy side standpoint. As well as probably attached to that, the whole point around the underlying valuation, which has to be, or which forms the basis for those transfers, and whether that valuation is actually accurate, whether this will be accepted by the tax authorities. On a recent deal, we had a discussion about the deal consisted of 2 jurisdictions basically, and comprised a whole lot of individual SPVs, which then had to be allocated to those 2 jurisdictions. And there was a certain degree of subjectiveness attached to that. So the risk associated with that was whether the tax authority in jurisdiction 1 might actually claim that A, the valuation wasn't exactly right, plus B, that certain additional SPVs would have to be reflected in that sort of jurisdiction 1 and therefore be taxable there as opposed to jurisdiction 2. And this was something which was quite sort of suitable for a product which Marcus referred to as a specific tax sort of contingency coverage, i.e. that is something which will typically not be reflected in a class A sort of W&I insurance, but that is something which can be and has been successfully addressed under a specific insurance policy, which again will have to be based on a more detailed and specific analysis of the risks associated with that. So in the example I was referring to, we have been provided with a rather comprehensive valuation report by a Big Four firm, which then formed the basis for insurers' discussion and ultimately got them comfortable on that. What's the remaining risk is that, of course, the tax authority, once they start analyzing this, might have a different view. There is obviously a different sort of incentive there, and you do not have sort of final confirmation from them how it would be treated. And that was indeed something where even it was solved under the deal transaction documentation, and the seller sort of retained that risk, but then turned back to us and said, look, why do we have to sit on this risk? We do not know when and to what extent that might materialize, but that is something we actually want to get rid of and structure that as a specific solution for some of those sort of tax risks which will still remain in that instance, at least, which were still remaining with the seller, even though sort of the carve-out and the actual M&A transaction was actually implemented as a rather clean exit with a minimal liability cap. So that proved to be a separate discussion, and that is indeed something which can crop up, obviously not only on carve-out deals, but some carve-out specifics are something we see time and time again cropping up on our radar when it comes to sort of to indeed implementing a clean cut as the product is typically sort of marketed with, so that to make that cut indeed as clean as possible, you have to think about potential sort of additional topics. It can be tax, it can be environmental, it can be litigation. So there is a whole palette of additional topics which can emerge on basically on every deal, but some of the things recurring, some of the recurring themes in the carve-out transaction have proved to be suitable for an efficient discussion from an insurance perspective. Taking a look at the clock and bearing in mind that it's late Friday afternoon, I would probably, and we still have a couple of points to discuss, but probably in the interest of time, probably last call for any questions at this stage. Doesn't seem to be the case, so it's either everything is clear or nothing is clear. But I think you all have sort of our details, and if there is anything you would like to discuss in a bit more sort of private setting, do reach out. Do let us know if there is anything we can clarify or provide sort of additional insights on. Feel free to reach out. And I think with that, Hoyla, another question before we hand over?
Yeah, could you maybe say a couple of words on pricing?
Yes, sure. Yeah, probably one of the more important elements. I think pricing, given the wide variety of sort of carve-out deals, it can be a 1 billion topic, it can be a 50 million, still to a certain extent similar complexity, but a very sort of different economic exposure. So I think you have to calculate a little bit of a premium compared to what you typically see on a, let's say, straightforward standalone transaction. Now, it will not be doubling the price. I would say it's probably, again, depending on the complexity, depending on the state of preparation of the overall process, depending on of course, the target industry and sort of the jurisdictional split, another important element. I think you have to sort of bear in mind a certain uptick in pricing. If you were to compare, let's say, a carve-out deal and sort of an identical target, but one being sort of sold on a standalone basis versus one which is facing sort of the typical carve-out complexities, there will be a slight uptick, but I think it isn't something which will massively impact the pricing. So it's not something which makes it sort of prohibitively expensive. And then I think, the range can be quite wide. Let's be frank about that. But it isn't something which is purely driven by the carve-out element. It is rather something which is indeed sort of driven by the overall combination of factors. Plus, as always, I mean, we've seen some funny discussions around pricing, in particular on larger carve-outs. And that was driven by the pure fact that sort of normally people are used to the insurance premium being sort of rather an amount, let's say somewhere in the range of 3 to 500K. On some of the larger carve-outs, you naturally you end up in a higher with higher absolute amounts, because you start off a very different sort of basis. If we're talking about a 1 billion carve-out and you're looking at a, let's say, 100 million limit, naturally the absolute costs attached to that will be somewhere about 1 million. And that is simply something where people then ask, okay, why is it all of a sudden that expensive compared to what we've seen previously? So there is a little bit more of sort of education to be done, or sort of expectations management. But I think it is something which can be more specifically discussed based on a specific target. A long answer to a very short and crisp question, but I hope it does provide some color.
Thanks.
Very good. Then with that, Stefan, I will probably hand over to you for some closing remarks.
Yeah, thanks a lot, Gennady. Thanks, Markus. Many thanks for this comprehensive overview once more. I don't want to do too much words, but to make a long story short, we do have had 2 intense weeks with a lot of webinars. We do have on Monday the last webinar about environmental risks in M&A transactions. Hopefully you're joining. We would feel very good on that. And then we have a little pause until the 8th of October, where we do have the cash release insurance topic then. If you're interested, join us. If you're interested in more M&A relevant topics, follow us on LinkedIn also. And I only want to say goodbye, good afternoon, have a nice weekend, and hopefully we see us on Monday.